Hey everyone, welcome back. If you haven't seen the first video yet, where we covered the introduction and chapter 1 of Beating the Street by Peter Lynch, do check it out first, because that one lays the foundation with some super interesting stories, including how a bunch of 7th graders beat Wall Street with their stock picks. Alright, let's jump into chapter 2. This chapter is a reminder that the biggest threat to our investments is not the market itself, it's our own emotions. Lynch opens with something so simple yet so true. The key to making money in stocks is not to get scared out of them. Lynch says you can read all the books in the world, follow all the tips, analyze charts and ratios, but none of it will matter if you panic every time the market dips. Just like how you can know everything about healthy eating, but if you can't resist the chips at midnight, well, Lynch compares investing to dieting. He even says when it comes to mutual funds, it's actually the people who don't follow the news or try to time the market who often do better. Why? Because they just invest consistently, month after month, rain or shine, no drama. And to drive home this point, Lynch talks about something called the Barron's Roundtable. Every year, a bunch of finance experts, including him, gather in this fancy boardroom filled with spotlights, cameras, and microphones. They sit there for hours debating where the economy is going, whether the world is ending, what sectors will rise or fall, and you know what? They almost never agree. One expert will say it's the perfect time to invest, another says a massive crash is coming, and these are people who manage billions. And Lynch admits he's a part of it too. He calls it weekend worrying. You know, when you read a newspaper headline or watch a scary news segment on TV and suddenly you feel like putting all your money out of the market. He says it's not just you and me, even professional investors fall into this trap. They let fear and headlines cloud their judgment. Peter Lynch shares a few years worth of these roundtable moments where everyone was super negative, convinced the world economy was about to collapse. And what actually happened? The market went up, which brings us to Peter's principle. You can't see the future through a rearview mirror. Basically, just because things look bad now doesn't mean they'll stay that way. And just because there was a crash before doesn't mean another one is right around the corner. He even shares some wild stories, like how in 1990, people were so panicked that even cab drivers were giving bond advice and barbers were bragging about buying putting options. Lynch jokes, if barbers are suddenly experts on advanced trading, maybe that's your sign to not follow the crowd. And here's where Peter Lynch really gives us something solid to hold on to. He calls it the even bigger picture. It's this idea that yes, bad news will always be there. Crashes will happen. Headlines will scream that world is ending. But over the long term, stocks have outperformed almost everything else by a lot. He says that over 70 years, stocks have given an average return of 11% per year. That's more than double what you get from bonds or savings accounts. Even with all the recessions, wars, crashes, scandals, stocks kept growing. He brings up something really interesting, the 1929 crash. That memory still scares people away from investing. Even people who weren't even born then, and because of that fear, they miss out on years of growth. He says there's been around 40 scary drops of 10% or more in the market over the years. And you know what? Every single time, the market came back. So instead of treating every dip like a disaster, Lynch wants us to treat it like Minnesota winter. Cold, yes, but you know it's coming. You bundle up and you wait for summer. Same with the market. Don't panic. Stay the course. When the market dropped over 500 points in one day during 1987 crash, everyone predicted the end of the world. But guess what? It was just one more correction. The market bounced back. So Peter Lynch's message in this chapter is super clear. Don't get scared out of the market. Stay consistent, have faith, don't let the news mess with your head. Because most people lose money not because they pick bad stocks, but because they sell too early out of the fear. Alright, that's chapter 2. In the next video, we'll get into chapter 3, where Lynch gives us a behind the scenes look at mutual fund investing, including how he helped the non-profit build their portfolio. Thanks for watching, and as always, don't forget to like, subscribe, and stick around for the next one. Let's keep learning together.